You are also familiar with forex trading, which involves buying and selling of currencies of different countries. Stock trading, we also know that in that case you buy and sell stocks or shares of big companies which are listed on the stock market. And then you are familiar also with the cryptocurrency trading, which involves buying and selling of cryptocurrencies like Bitcoin, Ethereum, and Ripple, and all others you know. So all these are known as markets, financial market. So let's discuss about the trading mechanism or strategy. How do people trade? What is the procedure that you are familiar? You're also familiar with these procedures. If you've ever traded a stock before, or you've ever traded a coins before, or a cryptocurrency, or a currency of a country, you've ever traded forex. So how did you go about it? How did you find out when to buy and how to buy and how to sell? How did you find out this? So how you find out is this your trading strategy. So let us discuss briefly on this. So first, let's talk about trading strategy. What is trading strategy? The trading strategy is a high-level master plan designed to achieve a specific goal under conditions of limited resources. So it answers two fundamental questions. The questions are what, where are you going, and how will you get there? Where are you going, and how will you get there? The where are you going involves like financial, we are talking about financial, in financial terms, you want to build wealth by trading. So the goal is what financial position you want to be, and then how do you get there? That's the two fundamental questions. So a strategy in trading is a systematic plan that dictates exactly how, when, and why you buy and sell a product or a goods or an asset in financial markets. How you do that, when you will do that, and why. That is what the trading strategy is going to tell you. So it is meant to remove emotion from the equation, replacing impulsive decisions with objective rules. So your strategy is designed by rules, which are meant to replace an emotional decision you could make as a human being. So let's discuss that. Let's zero in on that how, when, and why problem. It's a problem. You want to know how do you trade, and when you trade, and then why do you have to trade that particular asset. It's a problem that you want to find out. So if you get the correct answer, you make the right decision. Because the high failure rate in trading is almost entirely driven by behavioral traps and the lack of proper process. So, how people trade? Let's talk about the how now. People trade by manually executing a structured four-step cycle that turns market data into financial transaction through an online broker. Number one, number one of the how is this. They analyze the market. They analyze the market. Traders look for patterns or price discrepancies using three main methods. One of the methods is this technical analysis. They examine charts, they examine candlestick patterns, they check indicators to predict future price movements. I'm talking about the how. Then, apart from the technical analysis they perform also fundamental analysis, which involves rigorous study of economic data, company earnings, or interest rates to determine an asset's true value. So they want to find out what is the asset's true value, and then in that case, they have to rigorously study large economic data in order to find out. Because if you know the asset true value, you can now you will not it will prevent you from buying expensive products because you want to buy cheap and sell high. So if you don't know the real value, you may be buying high and selling low, and then you make a loss. Another method is order flow analysis. This is another method or another way of finding how to trade. Order flow analysis. Watching this involves watching the actual volume of buying and selling pressures in real time. Okay, so that is the number one process, which is analysis. How? Another procedure is they formulate a plan. That's what you do next. After defining how, after analyzing the market, after market analysis, then you now formulate a plan. So, because before entering a trader defines three critical price points. One of them is entry point. That is the exact price at which they will buy. Another of them is the take profit target. So the price where they will sell or secure a profit, that's the take profit target. And then the stop loss level, which is the price floor where they will sell in order to cut their losses short if the trade is going wrong. That is what is involved in formulating a plan. The plan they formulate will help them to pinpoint the entry point, the exit point, and then the stop loss. Then they move on to execute the order, which is the step 3. They actually log into their broker's platform and then execute the order. They actually buy and sell manually via the mouse and keyboard, via the broker online. And then step 4 involves managing risk and capital. This involves mathematical positioning, sizing, in order to protect the trading account. Because you have to do this also manually by calculating and checking and see how much, determine how much you are going to risk per trade. So you have to figure all this by yourself. All these have to be figured out by yourself. So these are 4 procedures. These 4 procedures are what you must follow every single occasion every single occasion you want to trade. Okay, so you have to figure it out. You have to figure out how, which involves analyzing, when, which involves timing, and why. So this is what you must do in order to carry out a productive trade. But I'm telling you that even after doing this, statistics shows that 98% of retail traders still fail, they lose and quit. So next, we are going to talk about crypto automation. Don't forget all this you must understand before you understand what node actually is.